Let me tell you about the best investment I ever made. It was not some hot technology stock that everyone was chasing. It was not a private equity deal that I structured with perfect terms. It was not even a company with strong recent performance or positive momentum. It was a restaurant chain that everyone hated, that the media was destroying, that customers were avoiding, a company whose stock had fallen 70% from its peak in just 6 months, a company that had suffered a massive, highly publicized food safety crisis, a company that analysts were saying would never recover, whose brand was permanently damaged. That company was Chipotle, and I made it one of the largest positions in my portfolio when everyone else wanted nothing to do with it. I started buying shares in 2016 when the stock was trading around $350. After collapsing from over $750, people thought I was insane. My own team questioned the decision. Other investors called me to ask if I had lost my mind. The headlines were absolutely brutal, day after day. E. coli outbreaks at multiple locations, norovirus incidents, salmonella. The CDC was investigating. Lawsuits were being filed. Customer traffic was plummeting at rates I had never seen for a major restaurant chain. Same-store sales were down double digits, quarter after quarter. Lines that used to stretch out the door were gone. Restaurants that used to have waits were empty at lunch. The brand was damaged, possibly beyond repair, according to every restaurant analyst I spoke with. They told me that food safety crises are different from other business problems. They told me that customers never forget. They told me that Chipotle would become the next case study in brand destruction, like Jack in the Box after their E. coli outbreak in the 1990s. Every smart investor on Wall Street was staying far away from Chipotle. The stock was on every avoid list. It was being used as an example of what not to buy, and that is exactly why I was buying aggressively, because I understood something that the market did not see through all the fear and negativity, because I understood something that the market did not. Chipotle's problems were fixable. The food safety issues, while serious, were being addressed with new protocols and procedures. The brand, while damaged, was not destroyed. Customers still loved the food. The business model was still exceptional. The unit economics were still outstanding. The management team was capable. And most importantly, the stock price reflected a scenario far worse than reality. The market was pricing in permanent brand damage and terminal decline. I was betting on recovery and return to growth. That bet paid off spectacularly. Today, Chipotle trades at over $2,000 per share. My investment returned over 5 times my capital. But more than the money, that investment taught me the most valuable lesson in investing. The best opportunities come when everyone else is running away. When a quality business faces temporary problems and the stock gets beaten down to irrational levels, that is when you should be accumulating shares aggressively, not when everything is perfect, not when momentum is strong, but when things look terrible and everyone is pessimistic. That is the setup I am seeing right now in 3 specific stocks, 3 high-quality businesses that have been beaten down by temporary problems, market overreaction, or macroeconomic concerns. 3 companies where I am quietly accumulating shares while everyone else is selling. Today, I am going to share these 3 stocks with you. I am going to explain why they are beaten down. I am going to show you why the market is wrong. And I am going to lay out the case for why these stocks could double or triple from current levels over the next few years as the temporary problems resolve and the market realizes its mistake. But before I reveal the 3 companies, let me explain my framework for identifying beaten down stocks worth buying. Because not every stock that falls is a buying opportunity. In fact, most beaten down stocks are beaten down for good reason. The business is deteriorating. The competitive position is eroding. The industry is in structural decline. These are value traps, not opportunities. The key is distinguishing between permanent impairment and temporary setbacks, between businesses that are dying and businesses that are going through a rough patch. I use 5 criteria to make this distinction, and I apply them rigorously to every potential investment. Let me walk you through each one in detail, because understanding this framework is more valuable than knowing the specific stocks I am buying. First, is the business fundamentally sound? This is the most important criterion. Does it have a competitive advantage that is sustainable? Does it generate strong returns on capital in normal times? Does it have pricing power? Does it have customer loyalty? Does it have network effects or scale advantages or proprietary technology or brand strength? If the answer is no, if the business was mediocre even before the problems emerged, then the beaten down stock price is probably justified. It might even go lower. I have seen countless investors buy stocks just because they fell 50 or 60%, assuming that the drop itself means the stock is cheap. That is backwards logic. The stock fell for a reason. You need to understand whether that reason reflects temporary problems or permanent impairment. A mediocre business-facing problems is not an opportunity. It is a value trap. I learned this lesson painfully early in my career. I bought a retailer that had fallen 70% because of same-store sales declines and margin pressure. I thought it was cheap. I thought it would recover, but the business had no competitive advantage. Customers did not care about the brand. The stores were not differentiated. E-commerce was taking share. The decline was structural, not cyclical. The stock fell another 50% after I bought it, and eventually the company filed for bankruptcy. I lost my entire investment. That experience taught me to focus obsessively on business quality. I am not interested in permanently impaired businesses, no matter how cheap they look on a price-to-earnings ratio or price-to-book basis. Second, are the problems temporary or structural? This is where the real analytical work comes in. A food safety issue at a restaurant chain is temporary. It can be fixed with better procedures and protocols and training. A shift in consumer preferences away from your core product is structural. It cannot be fixed with management action. You can tell the difference by asking a simple question. Can the problem be solved with management action and capital investment, or does it require changing fundamental aspects of the business or fighting powerful secular trends? Let me give you examples of each. Temporary problems include supply chain disruptions, which can be solved by diversifying suppliers or building inventory buffers. Temporary problems include execution issues like a failed product launch or marketing campaign, which can be fixed with better management. Temporary problems include cyclical downturns in demand, which resolve when the economy recovers. Structural problems include technology disruption that makes your product obsolete, like digital photography killing Kodak's film business. Structural problems include changing consumer preferences, like the shift away from soda consumption hurting Coca-Cola. Structural problems include new regulations that fundamentally change the economics of your business, like healthcare reform affecting insurance companies. When I evaluate a beaten down stock, I spend most of my time on this question: is the problem fixable? The market often conflates temporary and structural problems, especially during periods of fear and pessimism. This creates opportunities for investors who can correctly distinguish between the two. Third, does the company have the financial resources to survive the downturn? Even temporary problems can be fatal if the company runs out of cash or violates debt covenants. I need to see a strong balance sheet or access to capital that ensures survival through the tough period. Companies that are forced to file bankruptcy or massively dilute shareholders in a crisis are not good investments, even if the underlying business is sound. Fourth, is management capable of executing the turnaround? Are they addressing the problems directly? Are they being honest about the challenges? Are they making the necessary changes? Or are they in denial, hoping things will magically improve? The quality of management matters enormously in turnaround situations. Fifth, is the valuation compelling enough to compensate for the risk? Just because a stock is down does not mean it is cheap. I need to see the stock trading at a significant discount to what I believe the business will be worth once the problems are resolved. I want margin of safety. I want asymmetric risk reward where my downside is limited, but my upside is multiple times my investment. These 5 criteria: business quality, temporary versus structural problems, financial strength, management capability, and compelling valuation. These are what I look for when evaluating beaten down stocks. And right now, I am finding 3 companies that meet all 5 criteria. Let me tell you about the first one. The first beaten down stock I am accumulating is Starbucks. Now, I know what you are thinking. Starbucks, the ubiquitous coffee chain with 40,000 stores globally. How is that a beaten down stock? Let me show you what has happened. Starbucks stock peaked at around $120 per share in mid-2021. Today, it trades in the mid to high 80s, down over 25% from its peak. But the real story is not just the stock price. It is the sentiment. Investors are worried about multiple issues: labor activism and unionization efforts, inflation pressuring margins, slowing growth in the United States, competition from local coffee shops and cheaper alternatives, geopolitical tensions affecting the China business. Every earnings call, analysts grill management about these concerns. Every quarter, the stock sells off on any hint of weakness. The narrative has shifted from Starbucks as an unstoppable growth machine to Starbucks as a mature, challenged business. This is exactly the setup I look for: a high-quality business facing temporary headwinds with the stock price reflecting excessive pessimism. Let me walk you through why Starbucks is still an exceptional business and why the current problems are fixable. Start with a fundamental business quality, because this is what matters most. Starbucks has one of the strongest consumer brands in the world, not just in coffee, not just in food and beverage, one of the strongest brands, period. People do not just buy Starbucks coffee because they need caffeine. They buy it because of what the brand represents: status, quality, consistency, the experience, the atmosphere. Walk into a Starbucks in Tokyo, London, New York, Shanghai, anywhere, and you get essentially the same experience, the same menu, the same quality, the same vibe. This consistency is incredibly valuable and incredibly difficult to replicate. The Starbucks brand commands premium pricing that allows them to charge $5 or $6 or even $7 for a coffee that costs them less than $1 in raw materials to make. Think about that margin structure. 70 to 80% gross margins on coffee sales. That is extraordinary pricing power, and it is sustainable because it is based on brand and experience, not cost advantage. A competitor can copy the recipes, they can copy the store design, but they cannot copy 20 years of brand building and customer habit formation. The unit economics of Starbucks stores are outstanding, among the best in all of retail. A well-located Starbucks store in an urban area generates over $2 million in annual revenue. A suburban location generates $1 to $1.5 million. The capital required to build a store is around $500,000 to $750,000, depending on the market. This means the cash-on-cash return on a new store is 30 to 40% in year 2 or 3 once the store is mature. Where else can you invest capital and get that kind of return with that kind of certainty? Very few places. And these stores have long lifespans. Starbucks stores that opened 20 years ago are still profitable today, still generating cash, still serving customers. The business model is not dependent on fads or trends that fade. Coffee consumption is a deeply ingrained habit that persists across economic cycles and generational changes. The competitive moat is strong. Yes, there are competitors. Yes, local coffee shops exist. Yes, Dunkin' and Tim Hortons and McDonald's all sell coffee. But none of them have the brand strength or the customer loyalty or the real estate footprint that Starbucks has. Once Starbucks establishes dominance in a market, it is very difficult to displace them. Now let me address the concerns one by one and show you why they are temporary or overblown. Unionization. Yes, some Starbucks stores are unionizing. This creates headlines and controversy, but the actual impact is minimal. Only a few hundred stores out of over 9,000 company-operated stores in the United States have unionized. Even if that number grows to 1,000 or 2,000 stores, it is still a small fraction of the total. And unionization does not necessarily destroy profitability. Plenty of companies operate successfully with unions. Starbucks can afford to pay workers more and still generate strong returns. Inflation? Yes. Costs are rising. Labor costs, dairy costs, coffee costs, rent, everything is more expensive. But Starbucks has pricing power. They have already raised prices multiple times, and customer traffic has remained resilient. People who are willing to pay $5 for coffee are not that price sensitive. Starbucks can pass through cost increases without losing significant volume. Competition, this is a perennial concern that never materializes into actual problems. People have been predicting Starbucks' demise from competition for 20 years. It has not happened. Starbucks keeps taking share. Their customer base keeps growing. The moat remains intact. United States growth. Yes, the US market is maturing. You cannot grow store count at double-digit rates forever in a finite geography. But Starbucks is far from saturated. There are still markets they can expand into. There are still underserved geographies. And more importantly, they can drive same-store sales growth through product innovation, digital engagement, menu expansion, and operational improvements. The Starbucks Rewards program has over 30 million active members in the US. That is a direct relationship with customers that allows personalized marketing and promotions. This drives frequency and ticket size, and it is barely being monetized. The opportunity to drive incremental sales through the app and loyalty program is enormous. China. This is the concern I hear most often. Geopolitical tensions, COVID lockdowns, local competition, slowing economic growth. Investors worry that the China opportunity is not as big as Starbucks projected. I think this worry is overblown. Yes, China is more challenging than the US. Yes, there is local competition. Yes, the geopolitical environment is uncertain, but Starbucks has already built over 6,000 stores in China, and they are highly profitable. Chinese consumers love the brand. They wait in line for new store openings. They pay premium prices. The total addressable market in China is enormous. Even if Starbucks captures a smaller share than in the US, the opportunity is still worth tens of billions of dollars. And here is what the market is missing. Starbucks is not just a coffee company. They are building a digital ecosystem, the mobile app, the loyalty program, the delivery partnerships, the consumer data. This digital infrastructure creates switching costs and drives higher lifetime value per customer. Competitors cannot easily replicate this. When I look at Starbucks today, I see a business that will generate over $35 billion in revenue this year with operating margins around 15%. That is over $5 billion in operating profit from a company with a market cap around $100 billion. The valuation is reasonable, not expensive. The stock trades at about 25 times earnings, which is in line with its historical average. But here is the opportunity. If Starbucks can resolve the temporary headwinds and return to steady growth, if they can expand margins through pricing and efficiency, if they can continue building out China, the stock should trade at a premium valuation, not an average one. If the stock re-rates to 30 times earnings and earnings grow at 10% per year for 3 years, you are looking at a double from current levels. That is the opportunity I am seeing. A high-quality business with a strong brand and competitive moat, facing temporary headwinds that have created an attractive entry point. This is why Starbucks is the first beaten-down stock I am accumulating. The second beaten-down stock I am quietly buying is Meta Platforms, the company formerly known as Facebook. And I know Meta has recovered significantly from its lows in late 2022 when the stock fell to around $90. But even after the recovery to around $450 to $500, I still view this as a beaten-down stock relative to its true value and potential. Let me explain why. Meta is one of the most misunderstood companies in the market. Investors focus on the metaverse spending and the Reality Labs losses and the questions about TikTok competition. They miss the forest for the trees. Meta owns 3 of the largest social networks in the world, Facebook with over 3 billion monthly active users, Instagram with over 2 billion users, WhatsApp with over 2 billion users. These are not declining assets. These are growing platforms that dominate how billions of people communicate, share content, discover products, and spend their time online. The engagement is still strong. The user growth continues, particularly in developing markets. And the monetization is just beginning in many geographies and use cases. Let me give you some numbers that show why Meta is actually undervalued despite the stock recovery from the lows. Meta generated $135 billion in revenue last year, almost all of it from advertising on Facebook and Instagram. They have operating margins around 40% when you exclude the Reality Labs losses, which I will discuss separately. That is over $50 billion in operating profit from the core business. $50 billion. That is more than most companies generate in total revenue. And this is not a mature, no-growth business. Revenue is still growing at double-digit rates. The entire company has a market cap around $1.3 trillion. That seems like a large number. That seems expensive. Until you break down the valuation and understand what you are actually buying, the core advertising business, Facebook and Instagram combined, generates essentially all the profit, over $50 billion annually. If you value that business at 25 times earnings, which is reasonable for a high-quality, high-growth digital advertising platform with these kinds of margins and competitive advantages, you get a valuation of $1.25 trillion. So the market is valuing the advertising business at roughly the total market cap. That means the market is valuing WhatsApp, one of the most valuable communication platforms in the world with over 2 billion users, at basically zero, nothing. And the market is valuing all the metaverse investments, all the AI infrastructure, all the future optionality at basically zero. This makes no sense when you think about it logically. WhatsApp alone should be worth hundreds of billions of dollars. It is the dominant messaging platform in most of the world outside the United States. It has barely been monetized. Meta has only started rolling out business messaging and payments features. The revenue potential here is enormous. If WhatsApp monetizes even a fraction as well as WeChat has in China, we are talking about tens of billions in additional annual revenue at very high margins. And then there is the metaverse spending. Yes, Meta is losing $10 to $15 billion per year on Reality Labs. Yes, this is a speculative bet that may not pay off, but it is also an option on the future of computing If the metaverse becomes a major platform, if AR and VR devices become mainstream, Meta will be one of the few companies positioned to dominate that space. They are investing aggressively while competitors are sitting on the sidelines. This gives them a multi-year head start. I am not saying the metaverse will definitely work. I am saying it is worth a lot more than zero. The probability-weighted value of this option is substantial. Now let me talk about why Meta was beaten down and why those concerns are resolving. The stock collapsed in late 2022 for several reasons. Apple's privacy changes reduced the effectiveness of Meta's ad targeting. TikTok was stealing user attention, particularly among young people. The metaverse investments were seen as wasteful. Revenue growth was slowing. Costs were ballooning. Investors lost confidence in management's capital allocation. Every one of these concerns has been addressed or is in the process of being addressed. The Apple privacy changes hurt, but Meta has adapted. They rebuilt their ad targeting using AI and first-party data. The effectiveness has recovered significantly. Advertisers are seeing strong ROI again. TikTok is still a competitor, but Meta has fought back effectively with Reels, their short-form video product. Reels engagement is growing rapidly. It is becoming a meaningful part of the user experience on both Facebook and Instagram. And Meta is starting to monetize Reels more effectively. The metaverse spending continues, but management has made clear they are balancing investment in the future with profitability in the present. They cut costs dramatically. They laid off over 20,000 employees. They reduced real estate. They improved efficiency. Operating margins have expanded substantially, and revenue growth has reaccelerated. Meta is not a broken business. It is a high-quality business that went through a rough patch and emerged stronger. The market overreacted to the downside. Now it is underappreciating the upside. Here is what excites me most about Meta going forward: artificial intelligence. Meta is one of the leaders in AI research and development. They have built large language models that compete with anything OpenAI or Google has produced. They have open sourced much of their AI work, which creates goodwill and attracts developer talent, and they are integrating AI across all their products. AI-powered ad targeting drives better results for advertisers. AI-generated content recommendations increase engagement. AI assistants embedded in WhatsApp and Messenger create new use cases. This is not speculative future technology. This is happening now and driving real business results. The revenue opportunity from AI-powered improvements to advertising, from AI-powered content creation tools, from AI assistants and agents, this could add tens of billions in annual revenue over the next decade. And Meta is positioned as well as any company to capture this opportunity. When I look at Meta today, I see a business generating over $150 billion in annual revenue, growing at double digits, with operating margins that could expand to 50% or higher. That is $75 billion or more in annual operating profit within a few years. At a market cap of $1.3 trillion, the stock is trading at less than 18 times forward earnings. That is cheap for this quality of business with this growth profile. If Meta executes on even half of what they are building, if WhatsApp monetizes, if the core advertising business continues growing, if AI drives incremental value, this stock should trade at 30 or 40 times earnings, not 18. That implies significant upside from current levels. This is why Meta is the second beaten down stock I am accumulating. The third and final beaten down stock I am buying is Booking Holdings, the parent company of Booking.com, Priceline, Kayak, and OpenTable. This one will surprise people because Booking is not a household name for many US investors, but it is one of the most dominant businesses in online travel, and the stock has been beaten down significantly from its peak. Booking stock traded above $4,000 per share in early 2021. It fell to around $1,500 during the COVID crash. It recovered to around $3,500, and now it trades around $3,200, well below the pre-COVID peak, despite the business being stronger today than it was then. Why has the stock been beaten down? Several reasons. Concerns about a travel recession as consumer spending weakens. Worries about Google and AI search reducing traffic to online travel agencies. Competition from Airbnb and direct booking. Questions about growth now that travel has fully recovered from COVID. All of these concerns are either wrong or overblown. Let me explain why. Booking Holdings is one of the most underappreciated, high-quality businesses in the public markets, and I think most investors simply do not understand what they have built. They facilitate over 1 billion room nights per year. Let me put that number in perspective. 1 billion room nights means that, on average, Almost 3 million people every single day are staying in accommodations that were booked through a booking holdings platform. 3 million people per day. That is the population of a major city every single day, relying on Booking's platform. They do this across over 28 million listings globally. Hotels, apartments, homes, everything. They are the dominant player in Europe, where they have over 50% market share in many countries. They are growing rapidly in Asia Pacific. They are expanding in Latin America, and they are even taking share in the United States, where Expedia has traditionally been stronger. The business model is exceptional, one of the best I have encountered in my career. Booking does not own hotels. They do not take inventory risk. They do not have to worry about occupancy or maintenance or staffing or any of the headaches of actually operating hotels. They simply connect travelers with accommodations and take a commission, typically 10 to 15% of the booking value. Think about how beautiful this is from a capital allocation perspective. A hotel has to invest millions of dollars to build the property. They have to maintain it. They have to staff it. They have to market it. They carry all the risk. Booking invests in building the platform and acquiring customers, but once that is done, adding more hotels or more travelers costs almost nothing. The incremental margins on additional bookings are extraordinarily high, probably 80 to 90%. Every additional booking drops straight to the bottom line with minimal incremental cost. The competitive mode is very strong. Booking has a network effect. Hotels list on Booking because that is where the travelers are. Travelers use Booking because that is where the hotel selection is. This creates a self-reinforcing cycle. The more supply they have, the more demand they attract. The more demand they have, the more supply wants to list with them. Breaking this cycle is nearly impossible for competitors. They also have scale advantages. Booking spends billions on performance marketing to acquire customers through Google, Facebook, and other channels. This marketing spend generates a positive ROI because the lifetime value of a customer far exceeds the acquisition cost. Smaller competitors cannot match this level of spending and cannot achieve the same efficiency. Now let me address the bear case concerns. Travel recession, yes. Consumer spending is under pressure from inflation and higher interest rates. Yes, travel is discretionary spending that gets cut in recessions, but the secular trend of travel shifting online is far more important than the cyclical ups and downs. 20 years ago, most people booked hotels by calling the hotel or using a travel agent. Today, the vast majority of bookings happen online, but we are not done. There are still billions of travelers globally who are not booking online yet. As they come online, as internet penetration increases, as digital payments become more common, Booking's addressable market expands dramatically. Even if we have a recession and travel spending dips for a year or two, the long-term growth trajectory is intact. Google and AI search, this is the concern I hear most often. If AI can answer questions like, where should I stay in Paris, and book the hotel directly, do we still need Booking.com? The answer is yes. People do not just want an answer to where to stay. They want options. They want to compare prices. They want to see reviews. They want to filter by amenities and location and price. They want the ability to change their mind and rebook. This requires a platform, not just a single AI-generated recommendation. Booking provides trust and convenience that AI search cannot replicate easily. And even if Google or ChatGPT starts facilitating bookings directly, Booking can participate in that ecosystem. They can provide inventory to AI platforms just like they provide inventory to Google Hotel Search today. The key is having the supply, the hotel relationships, the pricing data. Booking has all of that. Airbnb competition. Airbnb is a great company. They have built an amazing business in alternative accommodations. But they are not a major threat to Booking. Why? Because Booking already offers alternative accommodations. Over 7 million of Booking's 28 million listings are homes, apartments, and alternative properties. They compete directly with Airbnb. And in many markets, Booking has more alternative accommodation supply than Airbnb does. The idea that Airbnb is stealing share from Booking is not supported by the data. Both companies are growing because the market is growing. There is room for multiple winners. Direct booking. Hotels have always wanted travelers to book directly through their own websites instead of paying commissions to online travel agencies. They offer loyalty programs and discounts to incentivize direct bookings. But the data shows that OTAs are not losing share. Travelers value the convenience of shopping multiple hotels in one place, comparing prices, seeing reviews from other travelers. For most trips, especially international or complex itineraries, People prefer using platforms like Booking. The economics speak for themselves. Booking generated over $20 billion in revenue last year with operating margins around 30%. That is $6 billion in operating profit. The company has minimal debt and generates enormous free cash flow, which they use to buy back stock aggressively. Over the last 5 years, Booking has reduced share count by over 25%. At the current market cap of around $120 billion, Booking trades at about 20 times earnings. That is reasonable but not expensive for a business of this quality. Here is the opportunity. If travel continues to shift online, if Booking continues taking share in underpenetrated markets like Asia and Latin America, if they continue buying back stock, earnings per share could grow at 15 to 20% annually for the next several years. If the stock re-rates to 25 or 30 times earnings as growth accelerates, you could see the stock at $5,000 to $6,000 per share within 3 to 5 years. That is a double from current levels. But even if growth is slower, even if the multiple stays flat, the share buybacks alone will drive strong returns. When you buy Booking at today's prices, you are getting a high-quality, capital-light business with strong competitive advantages, trading at a reasonable valuation with significant buyback activity. This is an ideal setup for long-term wealth creation. This is why Booking Holdings is the third beaten-down stock I am accumulating. Now let me bring all of this together and explain what makes these three stocks attractive as a group. All three are high-quality businesses with strong competitive positions. Starbucks has brand and real estate. Meta has network effects and user scale. Booking has platform network effects and supply relationships. All three are facing temporary headwinds that have created attractive entry points. Starbucks has labor and inflation concerns. Meta had the Apple privacy changes and metaverse skepticism. Booking has recession fears and AI disruption worries. None of these problems are permanent. None of them impair the fundamental business quality. They are all fixable or overblown. All three have strong balance sheets and generate significant cash flow. They can survive and invest through the tough times. They do not need external capital. They are buying back stock, which creates value for long-term shareholders. All three have capable management teams that are addressing the challenges head-on. They are not in denial. They are making the necessary changes. All three trade at reasonable to attractive valuations given their business quality and long-term prospects. None of them are screaming bargains, but all offer asymmetric risk-reward, limited downside if the concerns prove more serious than I think, significant upside if the businesses perform as I expect. This is my strategy for beaten-down stocks, refined over decades of experience and multiple market cycles. Find high-quality businesses facing temporary problems, not just any business that is down, not just any company facing challenges, but specifically high-quality businesses with strong competitive positions and sound economics that are going through a rough patch. Wait for the market to overreact and push the stock price to irrational levels. This requires patience because markets do not always overreact immediately. Sometimes the decline is gradual. Sometimes it takes months or even years for the pessimism to reach peak levels. You have to wait for the right pitch, accumulate shares quietly while everyone else is running away. This is psychologically difficult. It feels wrong to buy when everyone else is selling. It feels risky to catch a falling knife. Your brain is wired to follow the crowd, to seek safety in consensus. You have to override that instinct and then hold patiently while the problems resolve and the market realizes its mistake. This is often the hardest part. The stock may go down after you buy it. The negative headlines may continue. Other investors may question your judgment. You have to have conviction in your analysis and the discipline to ignore short-term noise. This strategy has worked for me repeatedly over my career. It worked with Chipotle, which I described earlier. That investment returned over 5 times my capital. It worked with Canadian Pacific Railway when I bought it during a period of operational challenges and pushed for management changes. The stock more than doubled. It worked with Fannie Mae and Freddie Mac, which I bought during the financial crisis when everyone thought they would be nationalized permanently. I made billions on those investments. It worked with General Growth Properties, a mall REIT that filed for bankruptcy during the financial crisis. I bought the debt at distressed prices and ended up with equity in the reorganized company that was worth multiples of what I paid. And I believe it will work with these 3 stocks, Starbucks, Meta, and Booking Holdings. But let me be very clear about something important. This is not a guarantee. Investing in beaten-down stocks carries real risks. Sometimes the problems are worse than they appear. Sometimes management fails to execute the turnaround. Sometimes new problems emerge that compound the existing issues. Sometimes what looks temporary turns out to be structural. I have had investments in beaten down stocks that did not work out. I mentioned the retailer that went bankrupt. I have had others. I bought JCPenney thinking I could turn it around. That was a disaster. The problems were deeper than I realized. The competition was fiercer. The secular decline in department stores was accelerating. I lost hundreds of millions of dollars on that investment. So this strategy is not foolproof, but when it works, the returns are exceptional. And I believe the odds are in my favor with these three stocks because they meet all five of my criteria. They are fundamentally strong businesses. The problems are temporary. They have the financial resources to survive. Management is capable. And the valuations offer compelling risk-reward. The key is patience and conviction. You have to be willing to look stupid for a while. You have to be comfortable with the stock going down after you buy it. You have to tune out the noise and the negativity. Because in the short term, the market is a voting machine driven by emotion and momentum. In the long term, the market is a weighing machine that values businesses based on their economic reality. If you buy quality businesses at beaten down prices and hold them long enough for the reality to be recognized, you will make excellent returns. This is not a get-rich-quick strategy. These stocks may not go up next month or next quarter. They may continue to languish or even fall further if the concerns intensify. But over 2 years, 3 years, 5 years, I am highly confident that these businesses will be worth significantly more than they are today, and the stock prices will reflect that reality. This is why I am quietly accumulating Starbucks, Meta, and Booking, not because I think they will rally next week, but because I think they will double or triple over the next several years, and that is the time frame I invest on. The question you need to ask yourself is whether you have the same time horizon and the same temperament. Can you buy a stock that is down and potentially watch it go down more? Can you ignore the headlines and the fear? Can you hold for 3 to 5 years while the thesis plays out? If you can, these three stocks represent compelling opportunities. If you cannot, you should stick with index funds or other strategies that do not require this level of conviction and patience. There is no right or wrong answer. Different strategies work for different people. But for me, buying quality businesses when they are temporarily beaten down and holding them patiently has been the most reliable path to wealth creation. And that is exactly what I'm doing with these three stocks right now.